Welcome. In this briefing, we're going to cut right through the daily noise of the price charts. We're here to analyze the fundamental structural changes that are turning Bitcoin from a speculative play into a strategic reserve asset. And frankly, this is a shift that leaders in traditional finance really need to understand for the decade ahead.
So here's how we're going to break it down. We've got 5 key pillars. First, we'll talk about how the market itself is maturing. Then, we'll get into the real game changer, the sovereign backstop. After that, the emerging corporate playbook. We'll look at the data for the institutional floor. And finally, we'll pull it all together and see what it means for Bitcoin's next decade.
All right, let's jump right in. First up, a market matures. The main idea here is simple but profound. We are moving way beyond that old, familiar 4-year cycle that used to define this asset.
Now, we have to start by addressing the elephant in the room, this number. A 45% correction from the all-time high back in late 2025. Now, for a traditional analyst, that might look like a classic bubble bursting. But the story here is a lot more complex.
The institutional perspective, like this one from VanEck, frames it completely differently. They don't see it collapse, they see an orderly deleveraging. What that really means is that over 45% of the peak leverage got washed out of the system. This actually reduces systemic risk. It gets rid of the short-term speculators, and it creates a much healthier foundation to build on.
In this slide, this captures that core shift perfectly. The old market, on the left, was all about retail sentiment, driven by the Bitcoin halving event. The new paradigm we're in now is all institutional. It's driven by big-picture macro liquidity, things like Fed policy and inflation. And the result? You get much greater price resilience and strategic accumulation during dips, not those brutal crypto winters of the past.
Okay, let's move on to our second pillar, because this is where the story gets really compelling. This might just be the single most significant development. The United States government has officially stepped into the ring as a strategic holder of Bitcoin.
And make no mistake, this was a deliberate policy evolution. It wasn't an accident. It all started with the Genius Act of 2025, which laid the federal groundwork. That then led to the creation of a formal strategic Bitcoin reserve, which mandated that seized Bitcoin wouldn't be sold off anymore. Instead, it would be held as a national asset.
The scale here is absolutely critical to understand. The US government is now sitting on roughly 198,000 Bitcoin. That's a reserve worth over $15 billion. This one move made the United States the largest known state holder of Bitcoin on the entire planet.
So the why behind this is the crucial part. And we have the official rationale right from Treasury Secretary Scott Bessent. This isn't about speculation. It's a strategic move to, and I'm quoting, consolidate the dollar's dominance in the digital age and to hedge against sovereign debt risk. What this does in effect is establish what analysts are now calling a sovereign floor under the price.
So with the government making that kind of move, it's no surprise that the corporate world is now mirroring that same strategic logic. They're taking Bitcoin from just a simple treasury asset and turning it into a strategic proxy for digital value. And of course, the prime case study here is MicroStrategy. Michael Saylor has effectively turned his company into a de facto Bitcoin proxy on the public markets. They've just been on a relentless accumulation spree. I mean, look at this. They now hold over 714,000 Bitcoin, and their average cost is right around $76,000 per coin.
Now, a key catalyst for more companies to follow suit actually comes from the world of accounting. It sounds boring, but this is a huge deal. A new fair value accounting rule from FASB now lets companies mark their digital assets to market. Why does that matter? It means they can report unrealized gains on their income statements. That was a major barrier before, and now that it's gone, Bitcoin is a much more attractive treasury asset.
Okay, so the stories about sovereigns and corporations are compelling. But as financial executives, I know you need to see the data. Is there actually hard, on-chain evidence to confirm that institutions are building this so-called price floor?
Well, let's start with the ETFs. Even with all that price volatility, the spot Bitcoin ETFs kicked off 2026 by pulling in over $1.2 billion in net inflows. And that was just in the first 2 trading days. This isn't retail panic. This is powerful strategic demand that shows institutions were using that price dip as a clear buying opportunity.
And the on-chain data gives us another layer of proof. The realized price, which is just the average cost basis, for the big whale wallets is sitting at around $62,000. Now, this isn't just some technical level on a chart. It is a massive psychological and financial support zone that's been built by a huge group of long-term holders.
And right here, you can see this clear split between what retail is feeling and what the institutions are doing.
The Fear and Greed Index, it's at extreme fear, basically total capitulation. But the key on-chain metrics tell a totally different story. The MVRV Z-score suggests extreme undervaluation. And maybe most important, exchange reserves are declining. That means coins are moving off exchanges into cold storage. That is a classic textbook sign of long-term accumulation, not panic selling.
So, when you put all these structural pillars together, a maturing market, a sovereign backstop, a corporate playbook, what's the credible long-term outlook from your peers on Wall Street?
Well, major financial institutions are putting out some very serious long-term price targets. JP Morgan's model, which adjusts for volatility relative to gold, is projecting a range of $170,000 to $266,000. Bernstein is looking at $200K by 2027, Standard Chartered, $150K by 2026. The key here is that these are not hype-based guesses. These are model-driven forecasts, and the primary driver is the institutional flow that we've been talking about.
And all of this brings us to the final, and I think, the most crucial question for any asset allocator today. With sovereigns like the US government and corporations like MicroStrategy acting as new anchors for this market, has Bitcoin's infamous volatility transformed from being a bug into a feature? Is it no longer just a speculative risk, but a genuine strategic entry opportunity? We've laid out the structural evidence for you. The conclusion is yours to draw.